Hello, everyone, and welcome to the private equity presentation of the Summer with Finance program put on by the Street Smarts. Today, our speaker is Ben Consoli, and he'll be talking on private equity and his experiences at CVF Capital Partners. Before we get into it, everybody in here is able to post questions under the Q&A tab that is on Zoom. And if your question is related to the slides that we're talking about at the moment, I'll try and get that question in there. And if it's not, then we'll save it later for the Q&A at the end. So with that being said, Ben, take it away.
Awesome. Thanks, Colin. So I'll just go ahead and share my screen. And by the way, if you hear anything kind of going over me, pretty loud noise, airplanes go over my house all the time. So if you hear me stop for a little bit, that's probably the reason. It's not an earthquake. So yeah, just to kind of give a little bit of intro on myself before we dive into the presentation. So I'm currently an analyst at CVF Capital Partners, and as I'll dive into a little bit later, we're a lower middle market private equity fund. Our headquarters is in Davis, California. I'm actually based in our San Diego office alongside one of the principals here, Stefano Cuisin. So we kind of invest, across the board. We're generalists, staying away from anything that's oil and gas as well as real estate related. But we'll invest in business services, business to business, anything that you've thought of as an industry and probably haven't thought of as an industry. That's probably a better classification. But yeah, that's kind of just a general overview of who I am and what I'm doing right now at CVF. So kind of just looking at the agenda, we'll dive into companies and in the private equity landscape, private equity structure, so you can understand really how private equity works, how people make money inside of private equity, and the value add that's created with private equity. And then we'll go into deal candidates and process. So how does a deal get from the start to finish, and what is the different steps in between? And then we'll dive into a little case study and maybe do some Q&A at the end. So to get started, let's just go into a little bit of the private equity background and my thoughts as to where it's going. So really, private equity traces back hundreds of years with the carry structure becoming popular back in the shipping industry. That was all the way back to the original U.S. settlers. Nonetheless, private equity began to really become formalized in the 1960s when the first large LBO structures came to fruition. You can think of the classic deals, the classic LBO deals that KKR purchasing RJR Nabisco back in the mid 80s. That's really where the pivotal moment in private equity occurred. At the start, the industry was really kind of a nascent industry, and the concept of leverage buyouts was relatively new. So really, like, private equity shops didn't really need to differentiate themselves all too much, from an industry perspective, scope perspective, value add perspective. Really, they just kind of had to know finance pretty well and understand the economics of leverage and things like that. As these funds started to, show progress and repeat returns, and LPs started to realize that there was true returns in the space, it really kind of established and cemented private equity as a formidable buyer of companies, and it really began to challenge both public equity markets and the corporate M&A world as a whole. So what happened is you started to see kind of larger funds being raised. Think the Blackstones of the world with Steven Schwarzman and P. Peterson raising their debut billion-dollar fund. I think it was early 90s or late 80s. And really at that point, scale became an advantage in a way because, like many other businesses, there's operational leverage inside of a company. So that means that your revenues are growing, but a lot of your operational costs are not growing at the same speed, or as a percentage of revenue, it's not growing at the same amount. So your dollars to the bottom line falls a lot quicker. So these private equity funds started to become really profitable. So management fees, like we'll talk about in a bit, started to accrue to the general partners, which we'll also talk about when we get to structure. But
Hey,
two
quick,
things
Ben. There was just a question
yep.
about the slides being shared. Is this just kind of like an introduction before the slides?
Oh, you guys can't see the slides.
Yeah,
Okay.
just
Uh,
okay.
you
There we
guys
go.
see, you can see them now?
Yep, there we go.
Okay, cool. Yeah, sorry about
Got it. Yeah, sorry.
that. Yeah,
All right,
so
there we go.
there's
We're
a
good now.
couple slides there. So I'm really at the 10 to 21 at this point. So we went through kind of the 90s, the 2010s, and that was really focused on kind of scale. And then two things from there really influenced the private equity landscape really in the last 10 years or so. The first being specialization within a fund, which we'll cover later also, and then Dodd-Frank. So from a specialization perspective, private equity groups became more kind of mainstream. And so private equity firms had to differentiate themselves from other private equity groups to have kind of a unique, unique pitch when they're raising capital from their LPs, but also they had to drive differentiated returns and become value add. Otherwise, you're just capital, you're not differentiated in any way. And then on the Dodd-Frank side, which occurred as a result of 2008, it was passed in, I believe, 2010. It imposed a lot of restrictions and regulations on big banks and insurance companies. So what that occurred is it made direct investments and lending a lot more difficult for the banks. So what they did instead is they started becoming major LPs into these private equity funds. So private equity continued to grow kind of as an industry. Turning to my outlook on private equity, I think it's a lot of the continuation currently going in markets in terms of increased specialization, larger deals, higher multiples in general as dry powder continues to accumulate, and specialized funds can afford to pay the higher multiples because they can drive value and they have a differentiated look into the industry. And then I think there's also going to be, an increased pressure on funds to drive ESG, which is, doing good for the environment, society, governance, while driving returns. That's something that a lot of LPs are requesting, and it's something that funds can differentiate themselves in, and obviously it's good for overall society as well. There also seems to be kind of a value add component of driving, so-called like conglomerate model. If you follow Mark Andreessen at all and what he says, he's the GP and the founder of Andreessen Horowitz, one of the big VC funds out in California. He kind of talks about the HP model, where the fund really starts to provide many of the key roles of driving a company. So, think finance, accounting, HR, recruiting, that kind of stuff can be outsourced and managed internally by the fund. And then those costs are spread across the portfolio. It really lets the companies run a specific business model as their core to their strategy, instead of, having them focus on building out an HR team or an accounting team and stuff like that. So that's kind of my outlook on private equity as an industry as a whole. And we can dive into the numbers behind private equity. So private equity is really part of the general M&A space, so mergers and acquisition market. This tends to be dominated by private equity in corporate M&A. I think like Apple buying Netflix or something along those lines. So you see kind of on the top right graph, private equity buyout tends to represent about $1 trillion worth of transaction volume annually, and that's concentrated pretty heavily in the $500 to $1 billion transactions, and then those larger transactions of the 2.5 billion plus. Those are really what you'll read kind of on the Wall Street Journal, those big headline names. The 2020 graph, it's not updated through the end of 2020, but 2020 ended up being about the same as 2019, even though the first half of 2020 was really, really slow as everybody kind of tried to grapple with what COVID meant for them and the future of their fund. And they started focusing a lot more on their portfolio companies. 2021 is actually on track to be the largest year ever as well. But nonetheless, that still is a lot smaller than what the corporate M&A market is. And corporate M&A tends to be about 3.4 trillion or so, hovers around that number annually. So that means it's about, private equity is about a fourth of the total M&A market. And so the reason that corporate M&A tends to be a lot more of a deal volume perspective is they're able to be more strategic in their purchases. So scale, they try to buy companies for scale, for vertical integration, et cetera. They can afford to therefore pay a higher multiple, as they're able to drive more value than the private equity funds themselves, because they're turning to kind of the point that I made before. They have the accounting systems already in place, they have the HR systems already in place, and there's a lot of value that you can extract out of that. And then occasional government involvement, that's a characteristic of corporate M&A, just because you can't have Amazon rule the entire world. So there is some occasional government involvement in corporate M&A, as well as private equity transactions too, but not as as diligent as when it's a corporate M&A. So kind of turning within the private equity landscape, there's really a lot of ways to kind of slice and dice what the fund is. So funds differentiate themselves, one, in the bucket of where they play in the market. So you have the mega deals like we talked about; those are above the $2 billion or $1 billion revenue, and total enterprise value above $1 billion. And then you have the upper middle market, and then middle market and lower middle market, and the size of the deals kind of goes down as you go through that, as you go through those different buckets. And then inside of each of those kind of little buckets, you can even more dive into the specifics of each fund. So a fund can be industry specific, so they can look at a specific industry, and then inside of that industry they can be in a niche industry as well. So like, I think if anybody of you guys listen to the All In podcast, David Sachs, he runs a technology venture capital fund, but he's not just pure technology, he's software as a service technology, which would be a niche within an industry. Funds also tend to be region specific, unless you're the big large KKRs and Blackstones of the world, where they're really diversified across the globe. But a lot of funds tend to be region specific, which we'll touch on when we get to CVF. You can be mission driven, so you can be investing specifically in LMI regions. You can do some kind of strategy in terms of intercountry commerce. You can invest directly into developing markets, stuff like that. And then outside of that, you can even diversify, or you can kind of dive into it a little bit more and go into specific strategy. So you have growth equity, which is focusing on obviously growth of the company. You have management buyouts. You have unitranche, which is essentially the entire capital stack, or you can do take private. Within all these classifications, there's a lot more that you can dive into as well. Just this is a general outlook into the private equity landscape as a whole. So with that, I'll kind of go into the career paths of getting into private equity, and then what it kind of takes to get into private equity itself. So the typical route and trajectory starts with investment banking and consulting or equity research. The typical route is, you go investment banking 2 years, get your MBA, and then jump ship to private equity, or, similar thing with consulting. It's a lot less common to go into private equity after doing equity research, so it's not common. But I'd say the most common trajectory is investment banking 2 years, MBA, and then go into private equity. Within, once you're on the private equity side, it just depends at what point you come in, but usually you come in as an analyst, and that takes 2 to 3 years to move up into the associate position, and then within the associate position, 2 to 3 years until you can, move up to the VP route, and then principal, partner, managing partner. Each fund really kind of has different titles, I guess you can call them. So some will have, directors, managing directors, stuff like that. But this is, just a general perspective as to how private equity funds are structured from a, role perspective. When you think about like what each one of these do, so analysts are for the most part at the, higher, at the big funds, analysts are going to be just running spreadsheets for the most part. You're not really going to be in management meetings all too much. And you're not going to be really driving all too many deals from, from start to finish. At the associate level, you start to become, a lot more involved in that. At that point, VPs, you're expected to start bringing in deals, at least a lot more than at the analyst role, and then principal, partner, managing partner, that starts to become a lot more relationship based rather than, being good at Excel. But with that being said, to get in, I think Excel modeling is helpful, and also it would help even at the higher end, at the higher range. So at the managing partner range, just to understand Excel modeling is probably beneficial, just because you'll know, what you're looking at, understand how it works, understand the drivers behind the business, stuff like that. Something that's also probably pretty useful is just being good at PowerPoint, being able to put together good, PowerPoint presentations so that you can, go through the investment committee and produce the PowerPoint presentations that look good and capture people's attention. You should be able to quickly be able to pick up understanding, the general business concept. So marketing, management, product, etc. Really, private equity is diversified in a way as a job, because you really have your hands in all concepts of a business. You're not really siloed into one concept within a business. You have to know really the entire spectrum of running a business and understanding business, at least at the lower middle market stage. You also need to be relatively read up on legal, because a lot of the documents that come through will come across your desk, and you should be able to understand the different legal concepts within the deal documents. So I'm not talking about like lawsuits and stuff. I'm talking about understanding corporate structure and legal structure. And then from, just understanding M&A in general, what drives returns, how people think about leverage, what general interest rates are, stuff like that. Outside of kind of the skills from a quality perspective, or from a qualities perspective, you should be, resourceful, professional, you should ask a lot of questions and just be curious in general. I'd say that just being curious is probably the most beneficial one, undoubtedly, because you'll ask questions about business, you'll dive deeper into the different concepts and everything along those lines. So I'd say, emphasize trying to just gain curiosity and gain new knowledge about different things. So turning to CBF, I'm gonna open my window. So turning to CBF, CBF is a lower middle market fund. We are, like I mentioned, industry agnostic outside of oil and gas and real estate. So we're an SBIC, so we can't really invest in real estate directly. And oil and gas is just too volatile for us. From a capital stack perspective, we invest in both mezzanine debt and equity. So we'll provide the mezzanine debt and the preferred equity. So if you think about like kind of a capital stack, you start with your senior debt at the top, and in a bankruptcy per se, the senior debt is going to get paid out first, and they have, a lien on the business in general. The mezzanine debt, which is where we start to become a debt capital provider, then you're kind of more risky, and hence you deserve higher returns and higher interest rate on that. And then from a preferred equity perspective, you'll typically have a liquidation preference, which means that you get paid out before the common, and you'll participate in the common as well, in the common equity stack. So once everybody in this capital stack gets paid down, then you'll have capital left over for common equity holders, and those common equity holders, which as a preferred equity holder, you're also a common equity holder if you're participating. From an investment criteria perspective, CVF, we tend to look at companies that are doing $1 to $7 million of EBITDA, 10 to $100 million in revenue, and we're looking to make investments of $5 to $20 million. We invest anywhere really on the western half of the U.S. We tend to classify it as west of the Rockies, with occasional expansion outside of that, say Texas. Really what we're looking for is just quality management team. That's something that in the lower middle market, and I think kind of in general, managers drive business value. And if you don't have a solid management team to, implement change and stay abreast of the market and, drive the internal team to where you want it to go, it's going to be very difficult to drive returns. So something we focus on very heavily is quality of management team. From transaction types, we'll do recapitalization. So for those of you who don't know what recapitalizations mean, it's just rejiggering this capital stack here. So occasionally, if a company's doing very well, they might want to take out a dividend on the company and pay themselves as the owners. And so what they'll do is they'll take out debt on the company and just use that debt to pay themselves out as equity holders. So that way they retain still ownership in the business. They don't have to sell any portion of the business, but they are a little bit levered at that point. We also provide growth and expansion capital. So if someone's looking to enter a new market or acquire one of their competitors or something like that, we can help in that regard. Management buyouts and total buyouts, we tend to land more on the management buyouts for the same reason that I was talking about before, as to we try to focus on quality managers. So what a management buyout is say a founder is looking to exit his company or her company, and they have a solid management team behind them that has enough capital or has enough business intelligence and stuff like that to be able to run the company post the founder leaving. And so we'll back the existing management team to buy out the old founder and kind of transition the business onto the next ownership group. And then ownership transitions, that's very similar to what I was just mentioning on the management buyout side. And the acquisition capital, I kind of touched on that. So we'll help them buy a competitor in the market. So now we'll kind of turn over to really how private equity funds make money. So everybody kind of thinks of private equity as investors, which obviously we are, and that's a good classification. But within private equity, there's a structure that a lot of people don't kind of really understand until you get into the actual industry itself. So I thought it would be helpful for you guys to kind of understand how private equity funds are structured and what it means for us to kind of invest capital, raise capital, and that kind of stuff. So here you'll kind of see that at the center of it all is a private equity fund that's typically structured as a limited partnership. And the limited partnership is made up and composed of obviously a general partner, and then you'll also have individual investors. So say, maybe Wells Fargo or, an endowment or something wants to make an investment into a private equity fund. They'll invest into the private equity fund as an LP, and an LP stands for limited partner. And so they'll make a capital commitment, say $10 million or something along those lines. They want to allocate to this private equity fund. They won't actually just straight up give you the $10 million. But what'll happen is when we want to make one of these investments here, as a private equity group, we want to make an investment into a company. We'll call the capital from the LPs and say, hey, you committed $10 million to our $100 million fund. So you're 10% of our fund. And we're going to make a $10 million investment. So we're going to call from you $1 million. And so Wells Fargo or whoever it is has to then go and transfer the money into the fund, and the fund goes and makes the investment. So it's not like we have the full fund just there available at any time. We have to call the capital from the LPs. So the private equity fund, as I mentioned, makes the investments. The general partnership and the management company, those are kind of interchangeable in a way. The management company gets management fees. So from the committed capital that the private equity fund has, call it 100 million. Management fees tend to be between the 1 to 3% of total committed capital. So annually, the management company gets a 1 to 3% fee on the committed capital during the investment period. And then once these investments are sold, the general partnership will get what's called carried interest. So typically there's a hurdle rate that hopefully everybody understands what IRR is, but IRR is essentially the internal rate of return, which just means what's your return on the investments. And typical private equity funds have sorry, the plane's going over now. But typical private equity funds have, an 8% hurdle rate, which means that our IRR has to be above 8% for us to get any carried interest. And once it exceeds the 8%, then the general partnership starts to get carried interest on those investments, which means they participate in the investments proceeds. So that's the little structure on the.
Cool. I just a question really quick. So the different, like the management company, general partnership, limited, the investors, would they be like in different positions in the capital stack that you showed in like the slide before? Or
So, okay, that's a good question. So this capital stack, right? The senior debt, we're not a senior debt lender. That's typically the big banks that you can think of. They'll lend independently into a company. And then CBF will be, CBF is technically the private equity fund in that transaction. So the private equity fund is making the investments into that portion of the capital stack. So we'll be providing the preferred and the mezzanine debt. And the investors here are all pro rata inside of the fund. So all these investors, say investor one commits 10 million, investor two commits 10 million, investor three commits 10 million into $100 million fund. That means that they're 10% each of the private equity fund in general. So they're just the investors into the private equity group, and then the private equity group will make distributions into the investors once all the proceeds from the investments are sold. Does that make sense? Okay, cool. So then this is kind of diving deeper into the economics. As I mentioned, the funds tend to be, have management fees of 1 to 3% of committed capital in general. And that means that every year, again, they're getting, 1 to 3% of the committed capital as a fee, which they can use to pay, the staff and the people that operate the fund. And so because, in the investment period, you're making investments and you're not getting any really capital back, and you're also charging a management fee, your returns tend to be pretty bad up front and in what's called a J curve. So in the first, couple of years of the investment, typically you'll start to then come out of the J curve as your investments start to come to fruition. And you start to, get capital back from those investments and start to, record the write-ups in those investments. And then once you're kind of in this period, which is kind of the growth period, that's when you're really realizing a lot of the exits of the fund and a lot of the capital coming back into the fund to distribute back out to LPs. And then what's called the harvesting period is when you're trying to sell all the remaining investments in the fund. And that's typically year 5 to 10 of the fund is the harvest period. And when we were talking about carried interest, that's what we get as a percent of the investments. that tends to be 10 to 30% of investments. And like I mentioned, the hurdle rate is 7 to 8% IRR. So that kind of covers a little bit of the private equity structure. Now we'll get into, deal candidates and process. So how does, how did the deals actually go through, the entire process from start to finish? So you'll start with a teaser and an NDA. So investment deals tend to come from investment bankers unless they're, direct relationships that we have. But investment bankers will send what's called a teaser. So the teaser kind of outlines, generally what the company does, their financials, where they're located, general region of where they're located, but it won't disclose, their name or anything like that. So you really don't know what the company is. You just know, hey, this is what they do and this is their size. Does it seem like a fit? If it seems like a fit, then you'll sign the NDA, which is a non-disclosure, so you can't tell other individuals about the transaction. And from there, once you sign the NDA and send it back to the investment banker, then you'll get what's called a SIM. That's a confidential investment memorandum. And what that is a more detailed kind of, it double clicks into the teaser and shows you really an outlook on the business, what the business does, who's the management team, their outlook on what they want to become. And it'll also kind of mention what they're looking for. So are they looking for a management buyout, or for expansion capital, all those kind of things. And if you look at the SIM and you like the business and you want to take a stab at it, you'll submit what's called an IOI, which is an indication of interest, or a term sheet. And those are non-binding, but what they do is outline what you're thinking in terms of the capital that you're going to provide. So are you going to make the investment? What's the enterprise value that you're assuming for the investment? What percent of the company are you going to be owning post-close? How much debt you're going to put on the company? All those kind of things are outlined in your initial IOI. That way the banker can kind of go through the different IOIs that they receive. So we're not just the only one bidding on the company. Typically, it's a bunch of different private equity funds or corporate buyers. So they have to kind of sift through the IOIs and understand who are the top. Tends to be 5 or 6 bidders that'll go and be able to meet the management team. So once your IOI is accepted, you get to meet the management team. If chosen, you get to go out to the business and be able to step foot at the business and see it for yourself. From there, you'll do some due diligence, and because you were able to meet the management team and see the company, you have a better understanding of value and what you want to offer for the company. So at that point, you will be structuring what's called an LOI, which is a letter of intent. And this is really just kind of a more detailed version of the IOI, and it dictates, the deal. It's just a more in-depth IOI. And so from the LOI stage, though, only one person is chosen, or one group is chosen. And that's who goes on to do due diligence, which is called, that's what the industry calls taking a deeper dive into the company. So what the due diligence kind of involves is a Q of E, which is a quality of earnings. So that just is confirmatory of what their financials are, so that you can
Hey, Ben, your microphone cut out for a little bit. You're still no sound. Nope. I can hear. Yep.
Okay, cool.
Yep. Now we're good.
I must have just connected to those. So we're on. Did you guys hear me at the kind of the LOI portion?
Yeah, we were at the due diligence part.
Okay, cool. So yeah, at the due diligence stage, the QOB is the quality of earnings. That's essentially just confirming that the financials that they presented are correct, and that's conducted from an accounting group. So you think Big Four accounting or local regional accounting firms. They'll go in and assess the company's financials and make sure that they're accurate and there's no really fraud going on there. And then you also kind of review all the contracts that they have with their customers just to make sure that there isn't any red flags, say like a customer contract that represents, like 30% of the business, 40% of the business is expiring in 15 days. That might be a big red flag. You'll, do an IP review, which is just make sure that they have all the intellectual property that they claim that they have. An environmental review, especially in California, is important because if you're on a site that has bad stuff going on under the ground, they might get kicked out of the site. I think I got to move a little quicker to be able to get to the case study. So from there, if everything checks out in the due diligence, you'll draft and sign kind of the legal documents, and then the funds will flow. So then you'll make the investment into the company. The sellers will get their money, or the company will get the money, and you'll be able to, now you're a new owner of the company. And kind of in this entire stage, you're creating what's called a value creation plan, which we'll kind of touch on in a second. You were going to say something, Colin?
Yeah, really quick. We just had a question that I wanted to get
Sure.
asked. So could you share the exit strategy, the percentage return, time horizontal holding period, et cetera, of the deal that the firm often considers before investing in a potential investment?
Yeah. So from a percentage return, like I mentioned, we have both mezzanine lending and the equity side. So on the mezzanine lending side, the interest rates that are being charged at the sub debt level is anywhere between 2 and 10 and 14%. And then from the equity perspective, we look at it in two metrics. One is kind of multiple on cash, so how much cash you invested, how much cash you get back, and IRR. So IRR tends to be 20% or so is what we're underwriting to, and what that translates close to 2x, 2.5x your cash invested. And typically our horizon period is 5 to 7 years. Often, at the 3-year mark, people start knocking on your door asking to buy the business from you. But our typical investment horizon is, 5 to 7 years. I think I answered investing in potential, but yeah. So if there's any, other questions, feel free to shoot me a Q&A. From what we're looking for in deals, so we're looking for a sustainable moat. So a company has difficult to replicate characteristics. That could be either it takes a lot of capital to get into the business, or they have a differentiated look into the business, or they have strong data around the customers, anything like that differentiates themselves from other competitors and makes it difficult for competitors to get into the market. Because the deals that we're doing are leveraged, you want steady cash flows. So you want to be able to service the debt, because debt requires you to be able to pay both interest and principal payments. So you're looking for steady cash flows. Like I mentioned, we're always looking for very strong management, since management tends to drive returns, and like I mentioned, they're risk-adjusted returns because your risk is just generally lower with better management teams. And then we're also looking for, obviously, industry tailwinds. You don't want to be the best violin oil manufacturer in the world, because there's just no violin oil, but there's not a big market for oil for violins. So that's tends to be what we're looking for in the candidates from a returns perspective. The four things that really drive equity returns are revenue growth. So the business has to have an effective go-to-market plan for when we're entering the business. You have to increase the scope or increase the number of product lines that the company has. There's a question here. How would you understand if the company has a strong management team? So there's a lot of research behind that, and we tend to apply that research to the management team. So you could do, a lot of firms do just like Myers-Briggs kind of questionnaires and stuff like that. We don't do that. We really do it kind of based on gut, and during these presentations, you really get to understand the management, their perspective on the industry, and something that you can also check is there's just their track record, things like that. It's more of an art than a science to be able to understand if a management team is good or not. But we place a lot of trust in the management team, so we have to have a lot of confidence in them going into the transaction. So the other source of returns is increasing margins and cost efficiencies. So growing gross profit margin through implementation of, say, technologies, or just getting better at overhead and stuff like that as well. So scale also gives you a lot of operational leverage and allows you to grow EBITDA, which is really what everything trades off of. Leverage also drives a lot of equity returns. So it magnifies equity returns. I wouldn't say it drives equity returns, but it does definitely magnify it, but it also increases your risk. So the more leverage that you have on a business, it means that you put up less cash on the equity perspective. So any incremental value that's created accrues to the equity holders. So so long as you don't go bankrupt, the equity returns should be higher for a company that has 10x leverage compared to 5x leverage. But that's commensurate to risk, right? So you have a lot more risk on that, so you should technically get paid for it in a way. And then multiple expansion. So multiple expansion is essentially what the business trades for. So if you're into the stock market or anything like that, you could think like PE multiple, price to earnings multiple. Why would someone be willing to pay more for a technology business than Kellogg? It's because there's a lot more opportunity and growth available to the technology company compared to Kellogg, which is well established and everything. So what you want to drive to be able to create multiple expansion is really implementation of technology. You want to professionalize the management team. People will assign value to being a market leader, and then strategically positioning yourself so that you have a strategic buyer rather than a financial buyer, since strategic buyers tend to be able to pay more for a business. So now we'll get into a kind of just a private equity example. I don't know that we're going to be able to get into the model, but I can follow up with just a general model as to what we're looking for here. But so ABC Tire Company is a violin manufacturer that is owned 100% by Sally and John Smith, both 65. So they're looking to sell a majority stake in the business to secure their retirement, which they expect to retire in 2 years. The company has historically generated, 35 million of revenue and 5 million of adjusted EBITDA. So for those of you who don't know what EBITDA is, it's just earnings before interest, tax, depreciation, and amortization. So you can think of it as kind of it's quasi cash flow, but it's really not. It's really just kind of an industry metric that everybody looks at. To get to cash flow, you'd have to subtract out, interest, principal, and depreciation, and CapEx, and taxes. but on average, they spend about $1 million on maintenance CapEx. Revenue and EBITDA have been consistent for the last 5 years. The Smiths don't do any advertising, and the company management team is below Smith is pretty strong. So what we're going to do, what I thought we could do, is just kind of go through revenue growth, margin and cost efficiencies, leverage, and kind of multiple expansion. So if you're thinking about revenue growth, what you're looking for is really, where's the industry going? So what is going on with the violins? Are a lot more people getting into instruments? Are they looking to, gain that capacity from a kind of a creator perspective? And then also, is there anything that the company can produce outside of violins given its current infrastructure? So that's what you're looking at for revenue growth. From kind of a margin and cost efficiency perspective, where's the company now in terms of their manufacturing capability? Is there anything that they can automate from the manufacturing perspective? And is there kind of any unnecessary costs that are going on inside the company? Can they kind of consolidate manufacturing footprint? Can they, maybe consolidate their accounting or anything like that? Or is there any, competitors that they can buy and just kind of merge into themselves? How much leverage? So the third one is leverage. How much leverage can this company kind of sustain? As the case study kind of alluded to, they've been pretty consistent for the last 5 years, I think is what it said. So you can be pretty confident in their ability to drive cash flow moving forward. So you can apply a significant amount or a good amount of leverage, a healthy amount of leverage to this company. A healthy amount of leverage in the lower middle market is like 3 times EBITDA. So that's what I'd probably look at this company from a leverage perspective. From a multiple expansion perspective, where are they in terms of the different industry players? What's going on with the industry? Because if the industry is kind of a dying industry, nobody's going to pay a high multiple for it when you sell the company, and things like that we kind of touched on. Colin, what do you think? Do you think I have time to go through the model quickly?
Yeah, no, we definitely have time to go through
that. So can you guys see this?
Yeah, it's shared.
Cool. So this is a sample model. We're talking about, adjusted EBITDA of 5 million. Typically,
it is really quick. It is a bit hard to see. Do you think you can zoom
in
a little bit to get the numbers?
For sure. Can you see that?
Yeah, it's a bit better.
I'll keep zooming.
Can we get it a little more? Yeah, awesome. That's great.
Cool. So we mentioned, EBITDA is about $5 million annually. Businesses tend to trade at a multiple of EBITDA. So, when you think about enterprise value, which is essentially the purchase price for a company, it tends to be just EBITDA multiplied by, an EBITDA multiple. In the lower middle market, companies tend to trade for anywhere from 3.5 to 8 times EBITDA, and once you get into like the bigger funds, you'll start to have much higher multiples. And Anatharam, I'll share the model after this session. So the way that you arrive at enterprise value, which again is just your purchase price, is just the TTM EBITDA, which is trailing 12 months EBITDA multiplied by the EBITDA multiple. For this one, I put 7 times. That's probably a little bit aggressive for just a steady state business, but that arrives at a $35 million enterprise value. Typically, when an owner is looking to exit, there will be some kind of earnout. So not the entire purchase price is given to the sellers at the close of the transaction. You'll have what's called an earnout, which is kind of a holdback of cash, but you incentivize them to keep the business running, over the next couple years to be able to get the incremental amount of cash. So what you'll do is you'll hold back that earn amount, and then you'll set targets for them to be able to get that earn out amount in later years. In this example, we said the company has to hit $35 million worth of revenue in 2022 to be able to even start getting any of the earn out. And if they hit $42 million, $43 million of revenue, then they get the full amount of the earn out in 2022. So what you get is cash at the close of $25.6 million for the sellers. So that's the amount of cash that they're going to be getting at the close. Obviously, this simplifies it because there will be like escrows and stuff like that. But for simplicity reasons, they get $25 million at the close. So once you arrive at your enterprise value and cash at the close, you want to create what's called the sources and uses. So where's the money to be able to fund this transaction coming from? And where is it going? So that's the sources tends to be, just the capital stack that we talked through. So you'll have senior debt, and then you'll have subordinated debt, and then you'll have equity investment. This isn't technically really a source nor a use of cash, but it's good to understand how much are you really paying for the business in the end based on the amount of earnout they achieved. So you can kind of disregard this one and this one for now, but just understand that the capital stack makes up the cash that's needed to get the transaction closed, which is the $25 million that has to go to the sellers at the close. So this would be us as kind of a private equity firm. We'd provide both of these, so the subordinated debt and the equity investment into the company. For simplicity reasons, we didn't have any role of the current company management, just made it simple for you guys. But typically you'll have like the CEO or the founders roll some of their equity into the go forward company so that they're incentivized to, work alongside you and drive growth. And so that, when we make money, they make money as well. So that's the sources and uses, some just general assumption about those sources and uses. So the senior interest, so the interest on this portion of the capital stack is 4.5%. Senior amortization, which is just how much do you pay annually on the senior debt. So you're paying principal down over an 8-year period. And then on the sub debt, so the CVF subordinated debt, it's 10% interest, 2% PIK. So what PIK is it's just accrued interest. So our all-in interest rate is going to be 12%, but they only pay 10% of it in cash, and they'll pay 2% of it accruing. So every year it'll accrue to the balance of the outstanding sub debt. Sub debt amortization, that tends to be about 7 years for the sub debt. And again, amortization is just how much of the principal are you paying annually. And then sub debt amort start year, that's when the amortization of the sub debt starts. So all these models tend to start obviously with the income statement. So anything in blue across the entire model, when you guys get it, that's an assumption. So if you change this, it changes things, whereas anything in black is a formula. So just be aware of that. So, we just modeled out the income statement for the next, 5 years, pretty simply. We just assumed a 5% revenue growth rate. So revenue is just, prior year revenue multiplied by 1 plus the growth rate. And then gross profit, we assume that some of the company will get a little bit more efficient with us as owners because we'll drive cost efficiencies and such. And so their gross profit as a percent of revenue will grow. I think you guys probably understand how to, forecast out an income statement through EBIT. And then the interest expense is kind of a tax haven for the company. So, the higher the interest amount, the lower your taxes are going to be, but it also comes with risk because that's a payment that you have to make. So, with our transactions, there is a good amount of debt. So there's a good amount of interest every year that has to be paid, and that shelters you a little bit from your taxes. So we'll get into how the interest is calculated in a bit, but the taxes are just assumed to be 30% of EBT, and that gets you to net income. Something that we always build out is what is the EBITDA for the company, and in this case, EBITDA is just earnings before interest and tax plus the depreciation amount annually. And the reason that we calculate this is because that's what businesses trade off of. So the two metrics that you want to look at from kind of a debt perspective is the total debt to EBITDA. So that's the amount of total debt that you have on the company divided by the EBITDA amount for the year. And so you'll see it's going down as EBITDA grows and as principal is paid down on the senior and the sub debt. Fixed charge coverage, this is something that you want to look at from a credit perspective. So fixed charges are anything that's kind of a cash payment that the company has to make annually. So that's going to be, your interest expense, your principal payments, any CapEx, stuff like that has to be paid by the company annually. And the numerator is going to be EBITDA, and then your denominator is going to be those fixed charges. So you want to see how much cash are you generating compared to how much cash do you have to pay out. So anything above 1 means that you're generating enough cash to be able to pay those fixed charges, but anything below 1 is bad. It means that you're essentially cash flow negative. So you want to monitor these two metrics pretty closely because banks are going to hold you to that. The earnout we talked about briefly, but it's based on the amount of revenue that they're going to get, that they actually generate in the company. So the minimum threshold is 35.6, the upper threshold is 42. So if they land anywhere between that, they get a portion of the earnout, which I think was about $5 million, $10 million. And so they achieved 25% of where they needed to be able to get the full earnout. So that means that 25% of the earnout is released to the company, to the sellers. And then I don't know if you guys are familiar with kind of a debt schedule in general, but a debt schedule essentially dictates, the amount of amortization that the company has on the senior debt and on the sub debt. And it also tells you, how much interest expense you have and whether you have to pull on the line of credit or not. So you just start with the amount of cash that the company generated. So that's just going to be EBITDA, minus any of those fixed charges that we talked about. And that'll get you kind of the cash flow generated or lost from normal operations. And then you add beginning cash, you subtract out the earnout paid because you have to pay that in cash to the sellers if they achieve it. And then you have some kind of CapEx that you have to do annually. And then you have, the minimum cash that you want to have in the bank account. So if this number is negative, that means that you're going to have to pull on what's called a line of credit, which is just kind of an available debt source that a bank will provide you. And so if this is negative, then you have to pull on your line of credit. If it's positive, then you can pay down your line of credit or just accrue that cash onto your balance sheet. Otherwise, you can pay an additional amount of senior debt or make a dividend or pay an additional amount of subordinated debt principal. So as I mentioned, the amortization of the senior debt is just going to be whatever your ending balance was or your outstanding balance was divided by the senior amortization years. I think we only have like 1 minute, so I'll chug through this. But
we have till 7:30, so we save 10 minutes ish for Q&A if we get those questions after. But so you can go. We have time.
Sweet. Okay. Yeah. So I'll keep walking through it then. And if there's any questions, feel free to slow me down. I'm trying to go kind of quick so that you guys can get through most of it. But so the way that we calculate returns for the fund is you have to back into what the equity value is going to be when you sell the company. So like we mentioned, our typical holding period is 5 to 7 years. So we made the investment at the end of this year, and we're looking what are the returns going to be in 2026 when we go to sell the company. Let's see, is your model or company research similar in any way to what banks normally do to determine credit affordability of the borrowers? Yes. So all of our transactions carry debt. So we typically have to kind of go and pitch bankers or banks on the senior debt that we're looking for. We provide the sub debt, so we don't have to pitch anybody on the subordinated debt. But on the senior side, we do have to pitch to them, and we know what the creditors are looking for, since we ourselves are creditors as well. So we're lenders, banks are lenders. So the way that we look at transactions are very similar to what a bank would look like. So they're going to monitor very closely these two metrics here. So the total debt to EBITDA and the fixed charge coverage, they're going to look at very closely. They'll have a couple other ratios like current ratio and senior debt to net worth, stuff like that. But in general, these are the two ones that they're going to look at the most. And what they'll underwrite is anything above 1.1 on the fixed charge coverage. So they need to make sure that you have at least a little bit of wiggle room on your on the cash coming in compared to the cash going out. So that's why they underwrite to at least 1.1. Typically, if your model isn't penciling to like 1.2 at least, they'll say you have to put less debt on the company, you have to provide more equity. So yeah, very similar since we are creditors ourselves. So we're getting into what the equity value of the company is, from when we make the investment through when we sell the investment. So the way that the equity value is calculated, similar to how we did it up at the top, you first arrive at enterprise value, which is again just your EBITDA multiplied by the multiple. We assumed 6 times is going to be the exit multiple here, and that gets you to $49 million enterprise value at the end of year 5. So from going from enterprise value to equity value, there's a couple things that you have to add and subtract. So you add cash to enterprise value because that's technically cash that the owners own. You subtract out any transaction costs. So typically when we sell a company, we'll engage an investment banker. An investment banker will take a percentage of the total enterprise value. There will also be legal fees. There will be fees associated with like the accounting, things like that. So there's always a good amount of transaction costs when we sell the company. So we subtract out transaction costs since we're going to have to pay that in cash. Then you subtract out senior debt because the debt has to be paid before the equity holders get paid. And then you'll also subtract out the sub debt because the subordinated debt lenders have to be paid before any of the equity holders get paid. And that, once you do this calculation, gets you to equity value, which is the amount of cash that's available to the equity holders. In this case, we own 100% of the company because there was no other owners going into the transaction. So that full 43 million is available to us as the sole equity holders. So from an investment return perspective, what we're like I mentioned, we look at IRR and we look at times your money, which is just a multiple on your invested capital. So we invested $8 million at the start of the transaction, which is just coming from the sources and uses. So we invested $8.4 million in equity into the company, and that gets us 100% of the company at that time. And by 2026, the equity value that the company is worth is 43 million, which equates to an IRR of 38% and times your money of 5.13. That would be an awesome investment. I wish all investments kind of generated that type of return, but that gets you through to understand the IRR and times your money calculations for the equity. For the debt, it's pretty straightforward. I mean, the IRR for the debt is just very similar to how we calculated the IRR of the equity. It's just, our initial investment is just the debt that we put into the company, which is 7.68. And the cash flows then that were generated throughout the investment period. So this is just going to be the interest that you got from the amount that you put in. That in 2022 and 2023 you got interest, 2024 you got interest, 2025 you got interest and some principal payment. So you also got some cash that paid down debt, and then at the end of the investment you get paid the amount that's still outstanding of the debt. And so then from there you could just calculate the IRR and times your money. And then we also look at blended returns because we are both the sub debt and the equity holder. So we look at blended returns, which is just the summation of the two. So you'll see it's just that plus the investment on the equity side. And so yeah, then we kind of summarize it into a table here that you can see the equity IRRs, the equity multiple. MOIC is just multiple on invested cash. It's just times your money. It's the same exact thing. They're interchangeable. And then we also tend to run, IRR sensitivity analysis. So what do the returns look like if revenue growth is negative 5% and our exit multiple is 5.5 instead of 6? And what is the equity returns if the returns are what the growth of the revenue is actually 5% compared to 0% compared to negative 5%, and what does the exit multiple do in terms of the returns on the equity investment? So as you'll see, the exit multiple will drive a good amount of the returns. So if you have a low exit multiple, that means that your IRR is going to be lower, and if you have low growth, your IRR is going to be lower as well. So you want to be focusing on how much revenue growth can the company generate, and at the exit, what is it going to look like, and will buyers be paying a good multiple for it? We'll also obviously run our sensitivities for the entry multiple, revenue growth, profitability, so gross profit margin, SG&A, and just a bunch of other scenarios, such as, what if we made the senior amortization 5 years versus 8 years, 7 years versus 8 years, and the sub debt, whether we increase our interest rate or, make the amortization start at an earlier year or anything like that. So a lot of sensitivity analysis. The way that this table is generated, just for you guys to understand, what you do is you put the assumptions right here. So the assumptions for revenue growth you put right here, and the assumptions for exit multiple you'll put right here, and then you'll just highlight the entire table and go to data, go to what if analysis, go to data table, and the row input cell. So the row input cell is this row, and you want to point it to where that number is changing. So the place that is changing in this model is right here. It's revenue growth, and the column input cell, which is the vertical cells here, where is that changing in the model? And that's going to be here. And then you just click OK, and it'll automatically update this. It's a super helpful tool in Excel. It's probably one of my favorite Excel tools that they have. So that'll help when you're running a bunch of different scenarios. That's really all I got, Colin. Happy to answer any questions or dive into any of the specifics. But actually, I didn't mention this. I should have probably mentioned this. So when we're going into a transaction, the way that you dictate the sources of cash is you want to see, what is the leverage going to be on the company going into the transaction. So typically we'll underwrite the senior debt will be about 1 to 2 times EBITDA. So that's how you come to the amount of senior debt that you're going to put on the company. And then the amount of subordinated debt will underwrite anywhere from 2.5 to 3.5. And really that's how you get into the initial amounts, and then you want to stress test that by looking at these two credit ratios here. So if this fixed charge goes below 1.2, then you want to decrease the amount of total leverage or increase the sub debt amortization or the sub debt amort start year. So that's how you back into the sources and uses of the debt, and then anything that's left over that needs to be paid will come out of an equity check. And yeah, that's the only thing I forgot to mention there.
Right. And people were asking about if they would have access to the presentation. Is there like a link or something you can share if I open up the chat? Or
Sure. Yeah. To the presentation deck or to the model?
to the model.
Yeah. And I can send, would it be easy if I just, let's see. Yeah, if you open up the chat, I can just attach it. Is that a thing?
Yeah. So I opened up the chat and
Okay, cool.
Yeah.
Yeah, and just for reference, this is a pretty simple model, but it'll give you a good understanding of how to run private equity transactions and what private equity investors are looking for. Let me just go to the chat real quick.
Also, I do see that someone raised their hand in the participants. If you do have a question, please type it into the Q&A section. And also, while Ben is sharing this link, for those of you, thank you for tuning into the presentation. You have fulfilled the requirements for the program, and the Q&A now is optional. So feel free to drop any questions that that you have on anything Ben has gone over.
I have to stop share to be able to add it in, so just stop and share. Is there any questions?
I have a question, but let's get the link in the chat and then go into questions. Oh, there we go. Cool. All right.
Okay. Can you please suggest sources where we can learn more on valuation models? Absolutely. There's awesome courses, and there's really kind of the holy grail book that I can send. The author's name is, I think it was Rosenthal, and it's just called like LBO and investment banking LBO models. I'll send you a link, Colin. Maybe you can share it with the rest of the group.
Yeah, I can do that.
And then there's a lot of just courses online that you can just YouTube. If your school is part of the CFA Research Challenge, I highly suggest that. You'll get a good grasp of how to do valuation models and stuff like that. And we didn't do a DCF, so a discounted cash flow, which is kind of the centerpiece of all valuation models. We did was an LBO model, but DCF, which is discounted cash flow, is something that people will kind of require you to be able to understand and to be able to do. So if you're Googling or YouTubing, just YouTube those two. And then I'll send Colin the link to a book that's often read by a lot of the people in the industry. How about your work-life balance at private equity career? does it heavy work? Is it heavy work like IB, 80 hours a week, 800 hours a week compared to P and IB? Which one do you like most and why? Personally, I mean, it's so from kind of a work-life balance perspective, it really depends on just the firm that you're at and the culture. I mean, I know kids that are in private equity that do, the 100-hour weeks. I know people that do the 40-hour weeks, it can fall kind of anywhere in between. For me, it tends to be not as much as the 80 to 100 hours a week. It's probably anywhere between 60 and 70 on average. Maybe, yeah, that's probably a good range for my current job, but it varies by different companies. And then which one do you like more and why? So I obviously like private equity. I'm just trying to say it in kind of a nice way, but what you'll be doing a lot in investment banking is honestly putting together presentation PowerPoints, and you really have no skin in the game. So you're trying to pitch someone an investment rather than you yourself making the investment and generating your own ideas and then being held accountable for those ideas, because in the end, really, did you drive returns or did you not? It's from an investment banking perspective, we have this assignment, and the assignment is to get money into the company that's our client, and we'll do it kind of however way we can do it, whether the company is good or not. The goal is to just sell whatever the client's asking them to sell. So from my perspective, private equity is a lot more entertaining and gratifying as well. So on a career perspective, if you could give one advice to your past self, what would that be? I'd give. Can I give two? I'll give two. So one is just your network is extremely important. So you can be extremely good at Excel, but if you don't know anybody or know how to use that, those skills that you generated, then they're not worthless, but it's worth a lot less than if you have a network that you can show off your skills and stuff like that. So grow your network, and whether that be just like meeting a lot more friends your age, or calling individuals and trying to set up calls with people that are where you want to be in 10 years or whatever it is. Set up those calls as well. But yeah, I mean, that's not to discount not knowing Excel. That's obviously like table stakes, but grow your network as much as you can. The second one that I was going to say is that you have to understand the fundamentals. So like think from like develop your thought process is what I meant to say, is like develop the way that you learn, and understand how that fits in the context of where you are. So figure out how best to excel in the place that you are through understanding yourself, is my biggest suggestion as well.
And really quick before we get to this next question, the file that you shared, it was when you're typing in chat, there's like a option to share with just hosts and panelists or with everyone. And so I think it just got shared to the hosts and panelists instead of everyone. So if you could resend that to everyone so
Oh, yep.
people can see it again.
Right. Okay. Cool.
All right, hopefully.
Yeah, for me to edit.
You guys can see it. All right. Looks like we're good. They can see it.
Awesome.
Oh, all right. And all right. Does anybody have any more questions they'd like to put in the chat? if I'll give it a second, and if not, then I think we can wrap this up.
Sweet.
So
Well, I appreciate you putting it together, Colin. And I think you have my email. If anybody, has any questions post the fact, feel free to, give them my email. Or I could just post them in the chat. Yeah, I'm an open book. If anybody needs to reach out or wants career advice or anything along those lines, feel free to reach out. I'm in San Diego, by the way. I don't know if I mentioned that. So I'm not up in the Bay Area, and it's really hot out. I don't know if you guys can tell, but I'm sweating because I closed my window and it got super hot in here. But I can't really meet up in person, but I can. I'm happy to take any calls that you guys want. So my apologies for being far away from the Bay Area.
all right, I think I'll stop this recording.